everyone, Billy here from TradeProsper, and welcome to our introductory course on what is an option. Now, you'll understand from trading the underlying shares or stocks yourself that when you trade the underlying, it becomes very important to be right, or let me rather rephrase it, the emphasis lies on you trying to call the direction with some conviction of certainty that it'll go in your favor. And the second point is that risk management is a key function of trading to ensure that you protect yourself against all these unknowns that the market can throw at you. So what if I tell you that options comes with a solution to both those problems? Using options as a trading instrument allows you to dynamically express your view, and you can construct instruments or trading strategies far more flexible, which allows you the luxury of not always having to call the market 100% right. Buying options also comes with a limited risk. You will never ever lose anything more than the premium that you laid out at the beginning of the trade. But first, let's relate this to a concept that you are already familiar with. How do you protect your car against unforeseen events? Car insurance, right? So let me ask you these three questions. Why do you take out car insurance? Is it because you know you're going to bump your car? Or is it as a protection mechanism in the odd event that you do bump your car? The second question would be, do you have to use the insurance now that you have it? Or is this something that you will only use when you really need it? And the last question I'll ask is, was insurance free? And if not, what is the premium used for? In the case of car insurance, it's very easy to understand that you are paying for a month's worth of protection on your car. So every time the installment goes off against your bank account, you've bought time for that month. So in other words, for the next month until my next premium is due, I have protection that if my car gets damaged, I can fix it without incurring any additional costs. Now, this is exactly the same with options. When it comes to vanilla options, there are only two types of options we have to worry about. A call option gives the buyer of the call option the right to buy the underlying instrument. And similarly, a put option gives the buyer of the put option the right to sell the underlying instrument. Now, what is important is you'll notice that I said the right to and not the obligation to. An option therefore allows you the ability to control the underlying instrument, or shall we rather say the exposure to the price movements of the underlying instruments, but only if that price movement is in your favor. That is a fantastic place to be in. In other words, if the market doesn't move in your favor, all you do is you let your option expire worthless, and the worst thing that would have happened is that you've paid your premium. Let's look at an example. Let's assume you own a put option on a share. Now, the put option has to have a protection level, which is called a strike rate. That is the rate at which you will execute the trade when you exercise your option. So the strike rate is the rate at which you will sell the shares. One will use a put option if you think the market is going to go lower, in which case the premium of the put option will increase quite a bit. So by trading put options, if the market goes in your favor, in other words goes lower, you can sell the option back and make a decent profit. And if the market didn't go in your favor, in other words go up, you just let the option expire worthless. It is important to understand that options are very versatile in their use and their application. And as such, the true value cannot be explained really by just saying use an option when you want to and let it expire when you don't want to use it. But for now, the purpose of this intro was just to give you a very quick introduction as to what an option is, and we will focus on the more in-depth sessions in one of our other trading videos. But as an intro to that, one would typically use options for one of three things. One would either use it as an expression of leverage, so in other words, instead of buying the shares outright and spending the full amount of money on that shares, you'll spend a proportionate amount of money and just control the shares via the use of options. One could also use instruments as a hedging instrument. If you have money in your 401k and think the market's going to go lower, you could buy a put option, for example, and protect your 401k value. And the third use of options is to trade the abstract. In other words, the weird stuff like how do you trade time, how do you trade volatility, how do you trade anticipated market movements. That stuff will all become clear once you understand the true use of options. Thank you very much for your time, and I hope you enjoyed the session. This is Billy from TradeProsper, and I hope to speak to you soon. Bye-bye.